Hello, and once again this is Chris Walker, Vice President of Freedom One, with the next in our series of the 8-Minute Update. As before, we are continuing with our theme of Protect, Prepare, and Recover. Today's 8-Minute Update is Managing Your Investment Risks. We all know the stock market can be a frightening place. You work hard, diligently save, invest wisely, and wake up to find thousands of your dollars melting off your retirement account. If this describes you, you're not alone. In order to achieve our investment goals, we all know we need to take some level of investment risk. But what is risk? For our purposes, risk is simply defined as the possibility of loss. More specifically, we need to discuss what is investment risk. In this update, we will define the 5 main types of risk, learn ways to manage investment risk, and prepare an action plan to help you manage your investment risk. 5 different types of investment risk are volatility, which is nothing more than the fluctuation of the value of securities we purchase in your portfolio. The second and possibly most devious risk is purchasing power, also known as inflation. We all know that over time inflation will erode the purchasing power of our savings, and that we must invest to keep ahead of inflation. Business risk means don't put all your eggs in one basket. That if you were to buy any one security, that would lead to an undue amount of risk in the portfolio. Interest rate risk is when the value of the investments we own are influenced by the changes in interest rates. And finally, accumulation. Accumulation is the risk that we will not have saved or produced enough money to meet our retirement goals. There are 3 main methods or strategies for managing investment risk. The first is to match your investments to the proper time horizon. The second, diversification. And finally, dollar cost averaging. What is meant by matching your investments to the proper time horizon is to have a long-term plan to meet your long-term objective. As you can see listed here is the year-by-year performance of the stock market as represented by the Standard & Poor's 500. And you can see that in any given year the stock market may be up or down. This type of volatility would give many of us fear for the stock market. However, you can see that if we simply annualize the 10-year performance, the picture changes dramatically. The best way to read this chart is, for example, to look at 2005, where it was up roughly 11%. What that means is that between 1995 and 2005, the market returned on average 11.5%. And if you looked at even 2008, if you annualize out the prior 10 years, that still produced a positive 3.5% rate of return. The point being that longer term, the volatility of the stock market can be controlled. The next key method for managing investment risk is diversification. We not only allocate your funds among stock, bond, and cash mutual funds, we also will diversify amongst different types of funds. For example, in stocks we may use value or growth, large, mid, and small capitalization, domestic or international. We also use different types of bonds and cash. This type of diversification will aid the portfolio because different investments react differently to changes in the market. This also smooths out the performance and simultaneously decreases the investment risk. The third method for controlling investment risk is called dollar cost averaging. Although this may sound intimidating or very sophisticated, it's really nothing more than continuously investing on a regular scheduled basis in up and down markets, thus decreasing the timing of risk in a portfolio. An example of dollar cost averaging would be as if each month you were to put $100 into your portfolio, in our example here for 5 months, totaling $500. Each month, the funds that we would purchase would have different values. Our example here, the first month, $100 would buy $10 shares, which would give us 10 shares purchased. The following month, $100 at $5 per share would purchase 20 shares. Thus you can see the amount, although our monthly contribution stays the same, the shares that we purchase changes with the changes in the price paid. In this example, we start with a value of $10 price paid and we end with $10 price paid, which means that your $500 you put in bought 62.6 shares, which at the end of the period of $10 per share had a market value of $626. Thus, dollar cost averaging took out some of the volatility of the markets and aided by actually increasing the total value of your portfolio. We initially identified 5 different types of investment risk, and 3 different methods for controlling that risk. Each one of these methods has an impact on these different types of risk, thus mitigating and hopefully having a more successful chance for reaching your retirement goals. So what is it that Freedom One does to help manage this risk? On an annual basis, we rebalance your portfolio. We change your allocation in response to market events. And we utilize different mutual funds to provide diversification. We continually monitor the most suitable and cost-efficient funds. This provides us the ability to match your investments to the proper time horizon, as well as provide adequate diversification. What is it that you as an investor can do to help mitigate investment risk? The first is select what's the most suitable risk level for you by selecting the proper managed account portfolio, or MAP. We have designed an investor questionnaire to help aid you in this process. The second thing you can do is to invest a fixed or growing amounts at irregular intervals, or dollar cost averaging. This will allow you to purchase in both when the markets are high as well as when they are low, thus cutting out some of the volatility of the portfolio. Therefore, through this strategy of combined efforts of Freedom One and your MAP selection with contribution persistence, we're able to manage your investment risk. We all know that investment markets can be frightening, and there's a tendency to seek out low-risk investments. But we also know that these low-risk investments will not provide the long-term returns necessary to accumulate the dollars we will need in retirement. A low-risk investment strategy is far better than a low-risk investment. Once again, I thank you for your time and hope you've enjoyed this current 8-minute update. Our next installment will be May 7th, and your host will be Don Gregg with the topic of investing with a purpose. Thank you again, and I look forward to the next 8-minute update.